interesting measure, right? One measure, high real yield, means like that's a very good growth environment. That's one that you should do well in from a risk standpoint. Post GFC, it was inverted and perverted in a way where negative and low meant it was good for risk taking. So I think we're in a much more kind of normalized zone, which is to say, having real yields, kind of the 1% type of zip code is where we're supposed to be. I think that's a truer measure of economic activity than the previous kind of regime.
We've got about 60 seconds left in this segment, at least, and we can continue this conversation. How are you thinking about the relationship between the debate at the front end of the curve and the story further out along the curve? Are the two things connected right now? If they drop yields at the front end, what happens to the long end?
Well, they're connected and they're not all at the same time. So the front end of the curve is a much cleaner place to invest, right? Because it is clearly driven by central bank policy. So the closer you get to that central bank policy reaction function, the cleaner it is. As you go out the curve, yes, it's driven by central bank policy action, of course, but it's driven by so many other factors that are beyond your control, right? It has to do with inflation, of course, growth expectations, and this pesky term called risk premium.
Brilliant. John, does Dr. Myron know that?
I think Governor Myron does. I've got some respect for Governor Myron. Going into this meeting, he doesn't strike me as the kind of guy who takes big swings in the meeting. Would he take big swings when it comes to the dissent? I think that's a very, very different question today. I don't think he's going to go in and be rude to people and tell them they're all doing a horrendous job, but he could well be a little bit more aggressive with that dissent if we do indeed get one.
In other words, 100 basis point rate cut, is that what he thought it was deserved? Is that what we're going to come out and speak to later today? That I think is really
I'm not sure how much credible a number closer to 100 would be.
Does that rule him out for any kind of Fed contender?
Greg Peters is going to stick with us. Greg, it's good to have you with us. Up next on the program, Kathy Jones and Subhadra Rajappa.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
In case you missed it on Daybreak Europe, what does it mean if you're an entry-level coder? How much trouble do you think you're in?
Everyone in the age of AI really have to relearn which tool to use when. And if you are technical and you know how the coding works, you're actually more productive with Lovable. Anyone can learn to be productive talking to the AI, but there's an advantage for technical people.
Don't miss Daybreak Europe live every weekday.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It does look like the Fed will cut
25 basis points.
A 25 basis point cut.
If they do 25 bips or if they do even 50, the market should be able to take it.
The Fed will still probably be looking for 2 cuts this year.
3 cuts this year and more to come next year.
Somewhere between 5 and 6 25 basis point cuts out to 2026.
If you continue to see this kind of momentum on the labor market, to get several more cuts in the back half of the year.
There are signs that you'll continue to see that weakness in the labor market data.
If you look at the trend, it's weakening.
In the balance, the Federal Reserve will look at the labor market for now, but they have to keep one eye on inflation.
Chair Powell better sound relatively dovish.
He's going to provide very limited guidance.
The decision 15 minutes away. The consensus view, a move of 25 basis points. 2 outliers. SocGen, Standard Chartered, looking for 50 in about 15 minutes time. The scores into it look like this on the S&P 500, not far off all-time highs. We're down a 1/10% this afternoon. In the bond market, 2s, 10s and 30s shaping up as follows. Your bond yield curve looks like this. Yields higher by 4 basis points at the front end, 354. We have rallied a lot at both the front and the long end over the past 6 weeks.
Yeah, and we've seen even a rally in credit. Just to give you a sense of just how much 10-year yields have rallied. They are down from 4.37% as of July 30th, the last Fed meeting. They are now at 4.03%, just giving you a sense of that momentum.
A couple days ago, we popped 3.99 in the 10-year, and this morning we made a dash towards just for a cup of Sanka. But the answer is yield space is moving. Greg Peters is exhausted.
Go further out, go to 30s. Only a few weeks back, we're at about 5.
Yeah.
Come all the way back down towards 4.5%. And the way the curve has evolved through August into September. August, we had a bull steepener, big rally at the front end. September, it's been completely the opposite. We've had a bull flattener led by the long end.
And the reason for it has been different depending on the person you've spoken to. Some people say it's because of the threat of yield curve control or some sort of machinations in the balance sheet. Other people saying, look, if you have all these people in cash, you cut rates, well, they want to lock in that yield, so they're going to go out the curve. That's a new argument, and we're hearing it more.
Joining us now to discuss, Kathy Jones of Charles Schwab, Greg Peters of PGIM Fixed Income, still with us. Kathy, let's start with expectations. What are you expecting in about 13 minutes' time?
Yeah, we're looking for 25, which is the consensus. I guess there's an off chance it'll be 50, but given that inflation is still pretty high, I think it's going to be difficult to have a really aggressive rate cut at this stage of the game, even though the labor market's showing signs of deterioration. An unemployment rate in the low 4s is still not that far from what's considered full employment. And then you've got inflation at 3-ish and edging higher. It's very difficult to make the case for 50 in this environment unless you have a really negative view of where the labor market's going.
Given that backdrop, Kathy, why do you think there's been such a rally in the long end of the yield curve since the last Fed meeting?
Well, we've had the rally because, the expectation, we've had weak economic data and we have a greater expectation for rate cuts. And so, the market has a lot of rate cuts built into it out to 2027. So the long end's been pulled down by that. But I would point out that the curve is still steep and steepening. We're still looking at a steeper curve as we go forward, even if it's somewhat lower rates. I don't know that the long end can kind of get out of its way if we still have inflation pushing higher, and the dynamics behind inflation are still not great.
Kathy, what's your action plan to put cash to work? I understand we're before the meeting. Let's go after the meeting, but let's take it out to into next year as well. What's the Kathy Jones action plan given Fed chaos?
Well, we're hoping people aren't too heavily in cash at this stage of the game because we've been encouraging them to be intermediate term on the curve and up in credit quality. And I think that is still our plan. We'll see how Fed policy evolves. We'll see how the economy evolves. But we're really looking for a fair amount of volatility going forward. There's a lot of things on the horizon policy-wise that can shake up the market. So we don't want to go super long, but we don't want to sit in cash because I think the bias is still to cut rates.
Greg Peters, let's get to you on some of this. Why are so many people so comfortable just sitting and waiting in the belly of the curve?
Because they're positive carry, right? You positive carry and roll. It's the bond investor's dream. And so you look at just the level of yields, the steepness of the curve. It's it's a very good environment for just being in bonds, and I would say that's a global story, just not a U.S. story. So I don't think the bond quote unquote bull market goes away. I think it's a very robust environment for bonds. One point I want to just make though, just on volatility.
Sure.
What's really important to watch is the trend in volatility. Typically, what you see as the Fed enters an easing cycle, volatility broadly comes down. It pulls volatility down. So if you actually see vol actually move higher in this rate easing cycle, that could be a sign that there's concerns around, Fed independence, risk around the economy, all these other types of things. So it's something to watch for. It sounds like an arcane part of the market, but it's a really important one to get a view into.
Greg, how crowded is the long bond right now? The shorts were pretty crowded, and they got stopped out, and that was probably a significant part of it. At this point, how balanced is positioning?
Yeah, so positioning is much more balanced. So you're quite right. The move was around positioning, right? I think at the end of the day, we're fitting a narrative to the positioning trade more than anything else. But the positioning side is much cleaner. As a consequence, I think there's room again for the curve to kind of gently reach deep in here. But positioning has played a part. It will continue to play a part. And so this is, how we invest these days.
Kathy Jones, are you writing a strategy as a Fed cut, as a one-off, or as a series of rate cuts on the edge of Greenspan? What strategy are you writing right now?
Yeah, we do think there'll be a series of rate cuts, but we're not expecting the cycle, so much as we can tell at this moment in time, to be as deep as the market has priced in. So, and that's because our view on inflation is that it's going to remain stubborn because of tariffs, because of immigration policy, you name it, there are a number of reasons. And so we're looking at a series of rate cuts, but not as deep as what the market has priced in. Another reason we're being kind of cautious and anticipating volatility is because we think the market's gotten pretty far ahead of where the Fed is likely to go. And then you add in all the uncertainty about who's running policy at the Fed and the future, and it becomes a stew pot of factors that could cause vol to pick up.
And this is something Brian Moynihan was essentially alluding to earlier on this morning, that in 2026 you could have a sticky inflation story that may constrain that easing bias of the Federal Reserve.
Yeah, speaking not only to Brian Moynihan, but all of the people under him and the acceleration you're seeing in consumer spending, and then speaking to Scott Kirby over at United and hearing the same thing, this reacceleration in consumer spending, it doesn't scream some sort of slowdown or recessionary condition.
They're talking about resilience. We're talking about an equity market near all-time highs, investment-grade credit spreads near multi-decade tights, and yet we're having a conversation about whether this Fed in 7 minutes' time will cut interest rates by 25 basis points or 50. Subhadra Rajapra of SocGen is with us now for more. Subhadra, I want to get to you on that. The 50 basis point view, is that what you and the team are looking for, and ultimately why?
So I think the spirit of the call from our economists is the fact that given the information we have on the job market and the revisions, quite dramatic, the Fed has some catching up to do. So the idea is that the Fed is going to have to front load some of these cuts between now and the end of the year. So whether it's a 50 basis point cut at the September meeting and then another 25 basis point cut, or a series of 25 basis point cuts, these cuts coming earlier and sooner makes a lot more sense, given the fact that we now know that there's a decent amount of weakness in the labor market. That said, I mean, I am sympathetic to the market pricing of cuts, which is calling for, 3 cuts, but kind of more spread out as opposed to 50 basis points at the September meeting. The data, especially recent data, the retail sales data has been very strong. And outside of the labor market, most of the other data points that we've gotten, ISMs, et cetera, have also been somewhat surprising to the upside. So given the fact that, the economy is in a relatively good spot, the Fed does have a little bit of luxury in spreading out those cuts.
Subhadra, you're talking about the evening special on Sunday on C-SPAN. We want to talk about the B-movie, at least as Greg Peters was talking about earlier, the sort of drama in the background. In other words, to put it bluntly, how much does it really matter to you as a bond strategist what Stephen Myron says, given that he is a new governor and he has the full backing of the president?
It does matter. I think words do matter. I think the fact that if you at least optically, when you have maybe 3 governors dissenting for the first time since the late 80s, I think that that's really going to stand out. And what would be interesting is if you actually have dissents on the hawkish side. And that'll really make the meeting very colorful. I mean, if I could, I'd love to be a fly in the wall in these discussions over the last couple of days. But again, I think that these statements and sentiments do carry value. I think broadly speaking, I think that's what the market's trying to suss out as well, because if you look into the end of next year, you're looking at pretty decent amount of cuts being priced in. So the market is assigning a higher probability for a much more dovish, Fed committee, FOMC committee next year.
So, Barbara, Societe Generale is a Paris bank in a nation in a complete total uproar. We all know the French story, the politics and all. This Fed meeting is invaded by politics. Does Jerome Powell have to speak to the non-financial America out there?
Yeah, he always does. I think that the messaging has always been very clear and simple. They do look at policy for all Americans, all sectors of the economy. They are going to take into account that there are certain sectors of the economy that are particularly coming under, pressure, especially if you look at, the employment side of the picture. We still have haves and have-nots economy. So Powell, I think, is going to be very, very focused on trying to keep basically all constituents of the economy in mind while changing policy. And that's part of the reason why I think it makes sense for them to front load cuts, this year.
Kathy, for 4 minutes, less than 4 minutes until we get that decision. If you were in the press conference, what would your one question be to Fed Chair Jay Powell if you had one?
Well, I'm going to assume that whoever went before me asked about squaring up the dual mandate with the rate cut. And I would go on to ask a bit more about the concept of maturity matching on the balance sheet. This is something Governor Waller has talked about, and I think Stephen Myron might embrace as well. And I think that has some implications.
On both sides. What is going on, family? Great to see so many of you. Thank you very much, Joey, for confirming this sounds all good. So, guys, let's have a look before Jerome speaks. Interesting to kind of look at open interest, because obviously, ultimately, this is a major sell the news event. And of course, we need to see what's going on, and particularly open interest over Binance, up marginally. And of course, KuCoin, few others showing green. That's on Bitcoin. I'm just trying to see any patterns of where the market is going. And ultimately, what we have here is the chart of Bitcoin, which obviously it's up. I did actually show a chart. I shared a chart the other day of the level of dips we've had since we had the April lows. So if you think back to, the April lows, we had 3 major dips, all averaging around, not even dips, I mean, corrections, I would call them. Between 11 to about 13% was the deepest one. And overall, I think they're setting us up here because the market is set to neutral. Now, the fear and greed index, I always like to look at various different ones. Binance is an obvious one. It's pretty neutral going in. So we may see the heat map today is, again, the bubbles over here. Let's have a look at this on the hourly. Few things are flipping green as we go into the Fed meeting in about a minute. I just want you to keep in mind, if you are trading this market, and we'll talk about crazy volatility here, and the chart is going off the chain. People are straight away being liquidated. And just to show you what that truly means is have a look at this. Have a look at this. I mean, look at this on the lower time frames and you'd realize how dangerous this shit really is. I mean, oh Lord. I mean, talk about being smoked, right? So we'll go over to this live again. We'll catch some of this. Good luck. Really, honestly, today it is the manipulation day, the biggest one that you'll ever see to be honest. And the Ethereum price here is just, it's oh, Lord. I hope you're all doing well, by the way. And let's get some of that, JP. And of course, look at this. I mean, imagine the people out there trading with leverage today. Probably so many good coins. We'll talk about narratives. And I'm going to show you what narratives have come back. Gaming has exploded over the last 7 days. Nobody knows exactly what the world's doing, but here at the DXB crypto community, we know exactly what's going on. But before I talk too long, let's see. JP is about to go at it any moment, and then we'll come back to it and see what's happening here. Yeah, Arrow don't give a damn. Oh, sorry, sound is off, huh? Thanks for letting me know, bro. Still no sound, huh? Where is the engineer? We've got we've got no sound. Tab.
Yet on how many rate cuts they're going to want to see, except Mr.
Call the tech support, man. What's going on with the tech support?
The 2.5% to 2% range.
Mike, I know you've got to run, but when you go into that news conference,
No sound.
you're
I
starting
can't
to think
believe
about
it.
questions already. What do you want to know from Chair?
Stop sharing. Ladies and gentlemen, we have a technical sound issue.
About 25 minutes
Right,
time.
it's
So
on
we've got
now.
25. The Federal Reserve ultimately met the market for 2025. 2026 is a little bit more interesting because this market, Bramo, as you know, is much more aggressive on rate cuts for next year than this Federal Reserve based on the median
X-Wells
in the
have
Federal Reserve
spoiled the news
projection.
for
Because
us.
as Mike McKee just indicated, the dispersion, which is something you talked about, the
Yeah,
spread
all
of
good
the
now.
dots
Brilliant.
for next year is incredibly
Thanks, guys.
And it makes one wonder if a certain dot has a greater weight than other dots.
And
given
you can
fact
hear
that
the screen,
market is
right?
moving on the idea of more cuts, even though some of the other dots suggested only 2 cuts this year and relatively few next year. And the Statement of Economic Projections talks about a Fed funds rate that ends next year well above 3%. We are now below that in the futures market.
Thanks, guys. You got a median, you got a central tendency, you got a home in the range and all that. Guess what? There's not a median statistic here above 2%. Is sub 2% economic growth politically acceptable coming up on an
Brilliant.
election? in
Can you hear the volume?
2026? I don't think
Just
so.
got
The answer to that is
Rose
no.
saying that
Which
the
is why
volume
this
is not.
Edge of Europe is what I'm looking at
To
here.
your point, TK, which is why this administration would like this Federal Reserve to be a lot more aggressive than these dots would imply.
Which is the reason why the market is hearing exactly what you're
Yeah,
pointing out, that
because
is
of that
not an
manipulation.
acceptable kind of reality. And that's why I think it'll be very interesting to see how Fed Chair Powell really gets behind this.
Greg Peters,
I think
you
it's
follow
more of the
story as it
tone,
evolves.
and
What's
we're
your
looking
initial takeaway?
for
Yeah, so
a.
the initial takeaway is definitely prioritizing growth.
We're looking. We're just looking for the actual future projections. His tone.
I am surprised.
And I think
by
that's
only
gonna
1% though.
actually see whether he's dovish.
Most people thought myself.
He's really. I mean, we've expected 25 basis points all along.
Is inflation itself. So
Stock market
is
running.
embedded in that forecast, is it still a, I'm sorry to say, transitory inflation component driven by tariffs that roll off over time? And so if indeed that is factoring in to the Fed, forward thinking,
Absolutely,
then that does mean there's more room for cuts because they're not as worried about that inflation component. So I would just be hesitant to look at the inflation number.
That would definitely shock the
in
system.
abstract. I think what's driving it underneath is the key.
To your point, there is a very clean, dare I say, convenient glide path back down to 2% in the forecast from 3.1 to this year, 2.6 for next, 2.1 after that, down to 2 for core PCE.
Yeah, there's a big rebuttal on that, and that is in the dollar. And you mentioned this earlier. And the idea that long-term bonds yields are falling, you're seeing a rally across the board in everything but the dollar, which just hit the lowest levels going back for the entirety of this year. That is speaking volumes about exactly what you just pointed to.
We just took out 119 on euro dollar. Let's head over to Europe and catch up with Bob Michael at JP Morgan in the heart of foreign exchange in the city of London. Bob, great to get your thoughts. You've had about 8 minutes to go over this one. What jumps out to you, sir?
Couple things jump out. Greg's right. One dissent was surprising. We certainly thought there would be 3 pushing for 50 basis point rate cuts and possibly 2 suggesting nothing. And then also the fact that 2 rate cuts were pulled forward into this year. We thought there would just be 1 more for this year. So more or less where we were last time. It tells me that this is a Fed that locked arms, felt this was time to reduce policy from what was surprisingly restrictive to them. They were probably shaken by the labor market revisions and thought, wow, we've kept policy a lot more restrictive than we thought. Let's start getting to neutral and let's do it in unified fashion. I think this is good for the markets.
Bob, good for the markets. Let's talk about which ones. It might be good for risk assets. How much can this keep being supportive for long-term bonds, given that theoretically higher inflation would come on the heels of a prioritization of growth, and typically higher inflation is bad for long-term bonds?
Well, I wonder if the indication of higher inflation is just a suggestion to us not to expect 50 basis point rate cuts.
Bitcoin is just chilling, which is exactly what we want.
a long time ago talking about a sub 2% potential GDP. Without COVID, tri-stimulus and all the rest and the legislation, these median growth estimates today, do we have to get used to this? Sub 2% real GDP?
It doesn't feel like we're going to have to get used to it. It
Yeah,
feels
I agree
like
with that,
we
man.
live in a world where policy will be generous on the accommodative side, both fiscal and monetary. We're looking at dots now, but we also haven't weighed in. Forget about tariffs. The One Big Beautiful Bill Act, that starts to hit in earnest in the first quarter. So I wouldn't be surprised to see GDP estimates go up next year.
For those of you just tuning in, about 10 minutes ago, 11 minutes ago, the Federal Reserve made the decision to cut interest rates by 25 basis points. There was one dissent, an individual looking for a 50 basis point cut. That was the newly minted Governor Myrick sent over from the White House.
Does he have a business card
at the Federal
yet?
Reserve. I want to get to something, CK. Check this out. Go to the dot plot and the projections. And if you go to the dot plot and you look at 2025, there is a very lonely dot at the very bottom of the screen, and it's sub 3%, not for next year, but for this year. There is a dot there just below 3% for 2025. Now, we were all asking, and of course, when you follow those things, there are no names on the dots. You don't know who they belong to, but I think we've got a pretty good idea who this might have come from. We've been asking how aggressive Governor Myrick might be. The dissent is one story. The push for a whole lot more for the year ahead.
You mean 125 basis points of rate cuts by the end of this year seems a little bit aggressive? Look, to me, that is notable, and it might be exceptional for people to hear that and absurd if you think about the growth in the economy. And yet, how much is the market trading off this? And I wonder, how much does this have disproportionate weight in the market? Because this is someone who really is coming with the backing of the president and could be some sort of signification of who he might pick next year.
I can see this picture at the corner of my eye. So let's take this picture. And for our audience at home, I'm just going to articulate what we see on the screen right now. So you've got this lonely dot for 2025. And then in 2026, you've got this additional story to think about. This massive spread in expectations from individual policymakers at the Federal Reserve. Lisa, they have got absolutely no idea what 26 brings, what 27 brings.
Correct.
This is a low conviction Federal Reserve. And you've got to bear that in mind when you go into this news conference. These guys are not gods. They haven't got crystal balls. They are clueless going into next year.
We're all clueless. And when we were speaking today to some of the heads of retail banking, what we have seen is retailers themselves don't know how much they can pass along inflation, how much there will be this elasticity in terms of demand.
Greg Peters is not clueless. I'm looking at the Bloomberg Total Return Corporate Index, and it is a miracle price up and yield down. Do you predict that we will see these acclaimed indices, Lehman, Barclays, et cetera, now the Bloomberg Total Return Index, they're going to break through and go through the highs of pre-COVID? I mean, we can have a new low yield regime that we just didn't think would occur.
I don't think so. I think that's heroic. I think the world has changed post-COVID. I think the environment of zero interest rates, negative interest rates will continue to be looked back on as a bad idea. That drove those rates to those levels.
I'm going to quickly tell you what to look out for. It's going to be down to his tone, okay, whether he's hawkish or dovish. And of course, in previous reports, we absolutely went through the BLS unemployment data, providing the reasoning for the cut. And we've got our cut. Okay. It's very clear that the job market is completely, absolutely weakening. So do we get another 100% or 80% odds of another 25 basis points in October? That's going to be very key, because he may want to just stay on the fences and go with a kind of give the markets not too much up front by suggesting we will assess or whatever into October. But clearly, don't fall for that, because the weakening labor market is 100% going to influence that. And whether we get 2 or 3 this year, that's another thing we're looking for. And we need to see, in addition, what the rhetoric, along with the tonality, and of course, Trump coming out, just putting way more pressure on this guy. That's all behind us now. The market has been pricing this in. Hence why you're seeing, for example, now we are, we're sitting here, we're chilling here, right? We are just literally about to, let's see if there's any changes on the lower time frames. It just gives you an idea of actually what's happening dynamically. We tapped 114K. This is such a volatile market. Nobody in their right frame of mind will be trading this until the dust settles. So Powell's going to be prompted very likely to explain and confirm the rest of the cutting cycle. Confirmation will emphasize the Fed's future plans, of course, with the market being so volatile right now. And then we expect 3 rate cuts in 25. Language from Powell can skew the expectation to the upside or the downside, depending on how he communicates, of course, and what questions those journalists who will set the trap, of course. I think those journalists, of course, being paid by big money to push him into a possibly whatever direction with their questioning. And remember that the scared Fed is one who wishes to cut rates closer towards their targets. And it's sad right now. A lot of people are being smoked. Retail are absolutely being being smoked. And a big pointer will also come really in terms of how they approach the ending of QT. That should be on your watch list. This occurs because, of course, in recent past, liquidity, they've been looking at the bond markets and everything else. And like we said in our private Discord group, we said liquidity will be swept on both sides. So that's what we're expecting. And right now, unless you're just trusting sell the news events, which we saw coming as far back as late July, early August. I've made videos about this. It's a brilliant time to take any advantage of what happens next. If the market goes up, of course, over the next, let's say, I'm planning for October anyway. From October onwards, you're fully allocated anyway. You've got the risk on side. And this is great for risk assets, by the way. Let's not make any mistakes about this. However, if we do see a sweep of the CME gap, which is absolutely, $100,000, possibly below. I mean, we could go as far down as 92K, but it doesn't really matter because the overall setup, Bitcoin dominance is not as strong as it was. And of course, when you look at the Bitcoin dominance on an 8-year chart, you start to understand this is the kind of seasonality that we're getting. We're having weak Bitcoin dominance. Even if people like Ben Cohen say it's going to sprint back up and try and test the 63-64% level, we're just going to get such a ultimate alt season here. But a lot of this is going to come down to how you play that emotion, in my opinion. I think everything is going to be, if Powell's wearing that purple tie, we are absolutely in for it. But the other dynamic is this whole Trump thing. Today, he spoke about this event in advance, and what we need as crypto investors is the economic projection. That's going to be important. Of course, various board members believe that the aspects of the policy in the future will be has to be different. And this will show us the opinion of the Fed in general and where they stand. Like you said, there have been dissents in this rate cut as well. There were those Fed members that were looking for a way deeper cut. But what does it all mean? Like for the average consumer, cheaper credit cards, the short term, housing will be impacted. Liquidity will flow into risk assets. We're going to get a better financial conditions, and that means we are going to get an alt season. You guys know that I'm a big favorite of one of my favorite charts is the total 2, and total 2 equals to alt season. I know many people don't look at the total 2 as that, but this will be our key alt season indicator. And if we look at this on the weekly, sometimes it's good to make these comparisons because you'd see where we're sitting overall in the total 2, and hopefully that will give you enough confidence in what the, this risk assets that we buy it will have a breakout on this particular chart. So if we keep it simple of the total 2, like if we look at this chart, if the economy is getting worse, like there's the stuff they're talking about now. So we are basically sitting, when this breaks out of the 2021 high, it means alt season basically. It's everything excluding Ethereum. So this should be, in my opinion, at least this should 3x the previous bull market. It always does. Like literally, we are going to see a top for the total 2 that's at least between 3 to 5 trillion. 3 to 5 trillion from where if it doubles right now, which it should, that's what we're going to get. That's why it's so important for you to actually just work on that portfolio and sit back and relax, because the assets we hold are very much undervalued. These assets are undervalued. So we've got big ways to go. And I've showed you another chart, which most people don't actually look at, but it's silly not to, in my opinion. That's why if a lot of people have no confidence in crypto right now, that is because they don't understand how the liquidity cycle works. And unfortunately, if you look at let me show you, for those of you who believe that the bull market is over, okay, you need to explain this to me, and I'll be happy to say the bull market is over. But what you're seeing here, first of all, let's all agree that crypto is bigger. There's more liquidity. There's more clarity. There's there's the Clarity Act, which is going to define. And that's the only effing reason why Coinbase are making a coin, a token, because of the Clarity Act, because the Clarity Act tackles specifically how much money you can raise in the US without raising any alarms. And you can raise up to $74 million without raising any alarms. You don't need SEC approval. Do you know how bullish that is? That's mental. So this is the reason why. So I'm going to give you reasons forget the short-term mindset. But if you've held on for 4 years, if you can hold on in the next kind of, say, 90 days, 6 months, whatever the short-term period is, because we will go to a bear market not too distant future, but we're not there yet. So I'm going to give you some compelling reasons. I want you to take note of that. If this market goes and does a nosedive from here, understand that the conditions have been set. And of course, we're looking for Powell to possibly address the end of QT as well. So number one, you've got the crypto total 2 market cap, everything excluding Bitcoin, has not broken out of their 2021 levels. We've come very close to it, and we are hovering at this level. So previous cycle, this cycle, and if anything, the network effect here is that it will 2 to 3x, possibly even more, or we should see more money flow in. Number one. Number two, we have the total DeFi TVL from 2021 not broken yet. This is DeFi Llama, and you don't have to look at this metric because this is specifically total value locked in protocols. But what you're clearly seeing here, I'm going to move myself, right? going to try and move myself, just get rid of myself here. What you see in here is one of the most important data, in my opinion. Crypto is bigger, crypto is better. However, we've not even surpassed the previous TVL. What does that mean? How can it be bigger and better? And then we trigger a bear market in September 2025 when we've just had a possibility of the first macro pivot, first liquidity cycle pivot since QT started in 2022. So this is the amount, 180 billion total value locked in 2021 cycle top. And that probably peaked towards the end around 2022. And now the highest we went was about 162 billion in the total value locked on all DeFi protocols in crypto. When the money printer comes on, we're going to go nuts. So you need to go hunting. Like, really, honestly, focus on the portfolio, because the data that I'm sharing with you here is not even like, this is this is the proof in the pudding, as they say. So if you can prove that crypto will not surpass its total market cap from 2021, then the bull market is over. But you can't prove that because the chart is telling you we are about at a breakout level. Breakout level is right here, 2025, 2021, right? So what's going to happen here is, what happens here is, you know, this is going to go wherever it wants to go. But one thing is very clear. I see, we just go here, you know, we are at a level of support anyway. And there we go, target that 3 trillion. Okay. That is very, very clear. Like, it takes a blind man to see that. So many of your altcoins today are completely and utterly, you know, are totally undervalued. If I tell you gaming is one of the fastest growing accumulation narratives by whales this week, you wouldn't believe me. I mean, I'm going to show that. I'm going to share that information with you. So this is the first thing you got to do. The second thing is, so now we've got two major evidence. Forget the regulation, forget the adoption, forget the fact that on-chain adoption is happening at a Wall Street level. There's about $7 trillion worth of money sitting on the sidelines that will foray into crypto. So I honestly believe anyone who's feeling bearish right now, you have already survived what you needed to survive. And if we go through another metric here, let me just show you. Just show you another metric here. So let's have a look at narratives. Top narratives. In the last 30 days, what we have is meme coins, Solana, and decentralized identifier, which is a new narrative, precision markets, artificial intelligence. Look at the last 7 days. So let's change this chart. Narratives that you think are well gone and dead and now leading the race. Unbelievable. There's people holding gaming coins right now, and gaming is only second for artificial intelligence. And gaming has grown by 32%. Meme coins continue to be in the top 3. So you must have meme coins in your portfolio. And AI in the last 7 days, not in the last 30 days, in the last 7 days, AI has effing picked up again. So what the hell are you waiting for? Can I get an encore? Do you want more? You mans want more. You're holding gaming tokens, your Echelon Prime's not doing well, your Beam's not doing well, your IMX is not doing well, your Gala Games is not doing well, and you feel like you're going to sell all of them now because gaming will never happen. Well, guess what? Gaming is second to AI the last 7 days. I wonder who's buying them. So guys, let's go to our favorite guy.
And in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the market slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Well, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, and tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmerosa of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. But what we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now. And so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
So just looking at the SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So that's what I meant by that.
We can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's, that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that the basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is it's an accumulation, a accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that, but it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss. We have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now, and they're making their arguments, and we're having a great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. And we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. Black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And markets has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor market when we do see signs like that. I did mention that, you see minorities, unemployment going up, you see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all this together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable mix for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve system and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to always trying to do better.
Neil.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things, but yeah, it's probably a factor. Hard to say how big it is.
Andrew.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%. Which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail, or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is, it's very clear that there's some pass-through.
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Karina.
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is? And what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us. And we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our job.
Good try.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you had about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut. And some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on
That's
inflation. At the same
uncertainty
time,
there.
we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Archie.
Thank you, Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
I'll follow up if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PCE numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great. We'd love that to happen. So I don't know that you see a big tension there, but it's gratifying to see that economic activity is holding in, and it's a good bit from consumption. It looks like consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting a fairly narrow sector is producing a lot of economic activity, which is the AI build out and business investment. So. We watch all of it, and I would say we did move up. The median for growth for this year actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole.
Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates, and that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help builders will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, for the big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. or a lot of places in the country just don't have enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to.
We will do a complete summary of what the big man is saying, but this is the impact on the market. This is what's happening. You're seeing bubbles. I think this press conference will probably get more interesting, but rather than looking at that, let's have a look at the market real quick, which is quite interesting. Everything is green right now, which is, this is a live bubbles here, but of course it's going to shift. It's going to turn. What I'm actually keen to discuss is, looking at liquidations. Today, I posted something in the Discord where we see not just today, the 24 hours is irrelevant. I think the next 2 weeks liquidation are completely stacked to the downside, but it doesn't mean anything. To be honest, it's just a buying opportunity. So guys, we can look at some coins. I would definitely say he is in a much better spirit. One of the key emphasis was not incredibly obvious which way I just took some notes, and tariffs contributing to 0.3 to 0 points to the core PCE. That came out of him. What coins are you eyeing? What are you looking at? What sectors are you buying, considering that we are seeing narratives that are continuous in the market? And do you have any, I'd probably ask you guys if you've got any strong altcoins. But the truth is, Powell this could have actually been very, very, this could have been worse, right? As always, the fallout is not now. The market has already sold. They've already priced in. You got Aerodrome here sitting around $1.20. Quality first. Gaming has really, really picked up, guys. I'm telling you, if we get one last opportunity of a dip, or if you're holding gaming tokens and your average is bad, DCA into some gaming projects. What meme coins are you eyeing? And see, meme coins, the two really strong ones. I mean, the strongest meme coin in the entire market is Pengu. And of course, we had a situation, we have an active situation with Kokoro, where the Cabal Kokoro has literally just took this out of Uniswap. And I think that's going to be in litigation. So hold on to some more news over there. But overall, guys, the market could have been worse. We still have a lot more volatility to come. However, it is going to be the seasonal bonanza to end this bull market. Whether it ends or whether we top 2024, whether we go all the way to next year, really next year, the economic picture might be more challenging. Okay. So, yeah, I think Vince, very good question there. Is Kokoro still a hold? I think at this low, it's very difficult. And I will look at Hydrex and Mirror as well. Both on base. Thanks for that shout out there. The thing with Kokoro is with meme coins, with low cap meme coins, one of the more unexpected moves could always be, a resolution of that situation and bang. Because as long as Vitalik, as long as he's sold, he's going to donate that money. And once he donates that money, that is a go, with all the exchanges. I think that is a massive, massive catalyst. So we've got to look at that. But right now, the biggest difficulty is, if you look at Kokoro, I mean, people are looking at the Cabal one, and Kokoro ETH is still sitting at $4 million in market cap. So for me, that is, and I do have, I mean, listen, there are a bunch of good meme coins that we have, really, really excellent ones. Today Toshi got listed on Binance Futures. It will be listed on Spot. But despite all the problems, it's sitting at $4 million. I think this is a great hold. And yeah, big up to you, bro. Big shout out to Caveman, because Pandu, Kasu, I think that's how you say it. Quays and OpenX, those have been absolutely flying. And thanks for sharing, because I think for those of us who bought, after you mentioned it, we're all up nicely. So that's going to be ridiculous, especially in the case of, for example, again, this is something that we've been talking about in the VIP group. But let's have a look at what's happened. The meta that you came up with today, I'm actually creating a watch list for it. But you have done extremely well. Sorry, waste. Q, how do you spell it again? Oh, sorry, case. We might be pumping or dumping, doesn't really matter. One thing we are for sure is we position ourselves for a generational exit. I mean, we only talked about it the other day, and look at this. Bam. That initial candle is absolutely, you've got decent buys coming in here for case, and that's how you say it. But yeah, happy days. I mean, this is a specifically brand new growing, an entire growing narrative, in the sense that this is robotics in general, modular robotics. And I think this is only going to get bigger. Like I said the other day, we saw the first ever, robotics kind of world championship over there in China. Bitcoin's making a meal of it. I wonder if the old man is spitting some good lyrics, good facts. This is the Bitcoin kind of, let's go down even further. We're just going to be chopping and whatever until they decide to send the markets down. They've got their big sell the news event. So they can F off now. Hydrex and Graham said Mirror. So let's have a look at these two. Hydraulics. By the way, I kind of use this quite a bit. I don't know if you've seen this, but it does really give you an idea of where money's going, right? So these arrows actually point from the left to right where money flow is happening. So a lot of money recently has been going from Ethereum, and this is the last 7 days, ETH to Solana, ETH to Arbitrum, probably more used for stable coins, and Solana has been bleeding. So BNB has seen a lot of inflows, Solana as well. But one thing you're going to start noticing is, for example, you start noticing the likes of, say, starting to appear in this big TVL, this big bridge movements, EVM. So mostly these are EVM compatible chains. All right. So I wanted to just share that with you quickly, but let's have a look at Bros Coins. Hydrex, Base has been pumping out quality projects lately. Hydrex and Mirror, HYDX, $6 million market cap. What we have here is a very good volume, about 5 million. Again, almost 1-to-1 between market cap and the market cap versus the volume. That is excellent. Again, not fully diluted, but supply right now sits at 78 million, of which 27 is circulating. Base contract here up 18% in the last 1 hour. So let's check them out. Let's check their socials. Again, with some of these projects on Base, I mean, we've seen Aventis do absolute wonders. We've seen few of them go nuts. And what's happening here? Let's just cut this off. For the sake of internet speed, what we have is, let's see. All right, okay, it's Base following them. So followed by Metacade, Marks, And base drop rewards for Hydrex accounts. So base is going with the base drop rewards. And we talk about base as well. I mean, that's going to be pretty good. I don't think we'll see it this year unless they've got the token ready. But I think that's a big thing. Frictionless liquidity hub. I think it's a good narrative. I mean, at the end of the day, what we have is base now becoming this cycle's BNB. I just wonder if they can. I don't think they've got enough time, to be honest, to introduce the token, especially unless it's a straight airdrop. Let me go share the screen. So basically, this is Hydrex. Protocol mining, provide liquidity to earn Hydro points. And let's have a look at the docs. So MetaDex and liquidity infrastructure purpose-built for base with an 8 million TVL. So basically, it's going to be competing with the likes of the lower dexes like your Alien Bases, your BMXs. But one thing I do like is the fact that you've got very good volume, very good TVL, all in relation to market cap. So this is super interesting. I like it. And partners, I mean, they use Chainlink oracles, Clanker, Base DeFi. I mean, sorry, Base protocols. It's very decent. I think I'd bang this one on my watch list without a fail. It's a pretty decent. I do want to see what happens with the base token as the gas fee. That is the bit where we're not sure now, because right now Aerodrome is the de facto base token, right? So we're going to see some madness there. I think it would be great. Let's have a look at Mirror as well. That's what I like about these lives, man. We share real alpha. So Mirror, I'm getting Mirror Protocol. Mirror as in Black Mirror, not the TV show, by the way. I assume you said Mirror, so it is this one on base. Now this one is on BNB. Mirror, mirror on the wall. So it can't be the Black Mirror. Mirror Protocol. Let's check this one out. If this is on base. Nah, it's none of those. So I'd probably need to get. Bro said Momo, good team. And on Coinbase, let's have a look at Momo. I have actually got, honestly, like I'm actively looking for Momo the cat, right? I think you mean, yeah, it has to be the. Here's Momo the cat. Let's have a look at this one. This one's on Sol. They all go like, all these coins got the same names. But I do have some pretty good, in the Discord, what we're doing now is we're going to have projects coming in super early, especially some meme coins with very good devs. So we have actually got a base dedicated a section for buy-let, especially low cap meme coins. Once I see the volume go past a certain number of buys, rather than risking it, we just trigger that as an alert. You can see what the token is. And I think that's going to grow. I'm going to try and add to the team and hopefully get more of those alerts out, because there's only so much you can do in the day. Momo the cat, this one's blue. Probably sure it's there somewhere. I got one more question. I still hold ALF, but it is a pain. Any positive vibes about it? So let's have a look at Alephium. Now, to be fair, I have turned, in my personal opinion, 27 million. You have a chart which is unbelievably kind of at the moment, price performance wise, it's really negative. There is not a lot happening. The volume is incredibly down. And the fact that it's on good exchanges, right, It's on very good exchanges, at least decent enough anyway for more liquidity to come in. I would need to say one thing about ALF. I think the team has done what they could, but because I just get the sense that the project has not had any breaks, it's hard at the moment to say that this is the volume that's flowing through it. And at least I want to see one positive aspect. So if it's not, if it's not listings, I want to see volume. If it's not volume, I want to see activity on the builder side. Now, activity on the builder side, I have no problem with. Currently, it's sitting at $27 million. And I do believe this should be the bottom for ALF. Now, we've had more here a couple of weeks back, or last month even. So I think the only way ALF's going to cut it now in a better liquid markets, it should start to move. What I'm doing is waiting for any extra alpha, AMA alert. So they've done another AMA here in French. And of course, my French is mainly reserved for swear words. So yeah, this is something I'm watching right now. I can't say for 100% whether this will wake up all of a sudden, because we don't see the volume. Until we see the volume, as investors, it's very, very hard to say, yep, that one's going to. I can show you projects that are in the same downtrend, or has suffered the same fate as Alephium. But many of the layer ones, even Kai Network, peaked for a very long time. The volume went out and they just stayed. I mean, Peak has made a recovery along with Deepin, which is very, very interesting. So I would say for ALF, watch this space. I checkmark the team, and the only thing that we don't have right now is volume, if I'm being honest, and that may be a catalyst for the markets turning. LL Cool J, that's the only double L I know. Let's have a look at Liquid Love. What is this? LLD. Lightlink. This sounds familiar. Very risky at the moment. Massive pump and a drop over there. Don't know what that is, but the chart is on its backside, down 90%. 140K in volume. Again, I saw this during that first hype phase. Nothing really excites me. At $3 million, I would probably get a meme coin in that category. That will do very well, to be honest. Because fundamental plays, there's just too many of them, right? It's too many fundamental. I've seen this before. I mean, this is an L1, I believe, if I'm correct. Let's go possible blockchain. Oh, sorry, L2. So it is, yeah, I'm not really like crazily hyped over layer twos, but I could be wrong. I mean, it looks, ecosystem partners here are solid. Did this come out of, what's the ecosystem? Interesting. Sorry, Lightlink Network. I used to think it's a layer one. Celestia. Okay, what are you doing with these partnerships? Okay. Look, man, they're listing Gate as a Web3 wallet. Come on. That's what I'm saying. Like, these partnerships could be very, very misleading. Layer 0 connects to blockchains and enables, but what is it doing with you? So to be fair, look, as far as high risk, high reward, we know Pith is an oracle. Do they just list every project with a utility? What are they doing with these guys? So Doc's team, check. I thought this was it's an Ethereum layer 2 that simplifies blockchain interactions. So now layer 2s I'm not bullish on overall. There's Optimism, there's Arbitrum, there's Base. Base is about to drop a token. But if you're going for as a pure degen gamble of something that could perhaps, with a team and that they're doxed at $1 million market cap, yeah, you'd have to take a gamble. But I'm not enthused. Those days of just buying projects like this are, for me, very much over, to be honest. I want to see volume. I want to see activity. I want to see some decent listings. KuCoin, not bad. Bybit, excellent. Gate, very, very good. Mexi, good. So exchanges wise, I think it's a calculated risk as long as you're happy with it. It should, it should satisfy a space in your portfolio, but I wouldn't put chunk of money in there. We'll just have to calculate it. Fetch AI, is it solid token as an AI focused play? Had to. I would not touch Fetch or ASI because obviously, there's a migration there. Fetch is now ASI first of all. 1.6 billion. Now, here's the theory. So it is smaller than Tau and it is smaller than Near Protocol. So you could actually, at one point, this was the biggest, artificial superintelligence was the largest AI token. But I do somehow believe that this had its major bull run back in 2024. I don't know after the merger, because the collective, all three projects were merged into one. It is fully diluted. It is an OG. It is the merger of these massive three AI projects, Singularity, Fetch AI, and Ocean Protocol. So I can see where you're coming from in terms of a chart perspective. From a chart perspective, I think it does look attractive in a big AI trend. I did show you the AI narrative is now coming back into town. However, I would just simply buy Tau. If I'm going over $1 billion, I would buy something with a halving, something that's going to be something that you can hold in 5 years and say, damn, man, I own this chunk of decentralized AI. Because I think as Tau becomes more scarce and has a halving every 4 years, so rather than the Tau halving being a hard stop annual halving on rewards, the Tau halving is specifically on inflation, right? It's based on the daily, so the mechanisms are different. So if I, great question there. I don't have any issues with Fetch AI, but Fetch AI and artificial super intelligence for me had its pump last year to $3. So right now, 65, I think it's still a relatively, big cryptocurrency with a 76 million in terms of the daily volume. So it's not bad. But of course, we have to go and assess the, long-term commitment to something like that. So I would choose Tau to answer your question. ST Stink. What is this, bro? Stonks. Is this on Tron? No, it's on Solana. $9 million, 200K volume, 581K total supply. Is that right? Am I missing a couple of dots? A couple of numbers, digits. It's on KuCoin. That's such a mad tokenomics, to be honest. $16. So this is obviously, this is the first meme coin. So this is obviously older than Bonk. Wow. Let's see where it came from. It's an ancient meme from 2017 starring the enigmatic meme man. His birth is on the Solana blockchain, was initially overlooked by most until now. Community has revived Stonk. And of course, they want to claim the top of the tree, basically. Liquidity pool locked, no pre-sale, contract renounced. Who remembers this? Is this even a thing, like from back in the days? This is, if that's the case, it'd be interesting to go on a deep dive to see what kind of whales and what wallet splits are there. But something like this, anyway, the only thing is the unit bias is against it from a retail standpoint, especially in a time and day when value for OG projects is diminishing based on this shit pump fund and all of these platforms just devaluing meme coins in general. But I am a sucker for historical artifacts, like, a couple of $100 in this maybe. And it's interesting. It's good, good shout. It does have a crypto sentiment, and followed by Crypto Milsey, Ricky from Kokoro. Few people follow that I know. But that's a good shout, brother. Thank you for sending that one across. I'll stick that into the watch list. Can you please check? So on over here, I can't click on links. Asta Dex. Hopefully they've got a CoinGecko. Man, I'm missing the Champions League tonight. This is like we had to do Champions League with Jay Powell. Asta Dex. Maybe this is on Dex. Guys, you've got to choose your coins very carefully. Like from here onwards, it's important to choose coins that are verified, backed. Look for good devs. Imagine Wojak's still sitting at $20 million fully diluted. And you can see here who's buying Wojak. Someone bought 6 million Wojak here. Interesting. Always monitor Wojak every now and then. It's a nice little Ethereum. So this is cool. What's the ticker? Asta. Yeah, send me just the ticker, so I don't take too long with these. This man's looking to watch the Champions League highlights tonight. Why would we run because of this? I'm trying to comprehend all of this. Ozzy, great question, brother. So the overall signal, like think of the economy first, like say we're just the riskiest asset of this bigger, much bigger, liquidity driven market. And think of this. So when money comes into crypto, so we are the riskiest asset, right? But the Fed really is cutting rates for the top 50% of families and businesses and owners and whatever. That's a fact of life. So what it means is money that would, of course, 25, the smaller the pace of the cut, the better for the economy. The more that it doesn't really spook out the market. And the more money, borrowing becomes easier, liquidity gets flush, liquidity comes into the system. In addition to that, these useless assets, which majority of crypto is, let's face it, people start actually big institutions and retailers will have more money. So overall, the cost of your credit cards will get cheaper progressively in a short space of time if you have 3 rate cuts. So just think of this as an injection. And on top of that, once they actually fully announce, because they are printing, right? Like in order for, the US is actually, US government is even buying its own bonds. But I do explain a lot of this in the Discord. And it is rather detailed. It actually shows you, let's see if I can actually find you a couple of good articles that we've done here. So if you ever end up in our DXB Discord, you will have something called, it's basically updates where we do a lot of project updates, macro updates, and everything else. So as an example here, over the next 2 weeks, what you're seeing is the amount of liquidity over 2 weeks for Bitcoin to the downside compared to the upside, right? And in terms of the overall macro moves, This is the kind of stuff that you need because the world is interconnected. One war or one set of, friction somewhere can't always put us like we saw with the Iranian war. So there's unpredictable macro events that take place. For example, no one's talking about this. China bans companies from purchasing NVIDIA, right? Will that impact tech stocks? Of course. Besson came out the other day and said 90-day pause potentially on tariffs. Canada cut rates. And in order to be, I'm just going to find something here because people do really need to understand. That's an excellent question. And what we can see, let me see what's going on here. Just to explain this to you a bit more. Again, you should really join our Discord. So these interest rates will basically stimulate and give the market confidence. The EU has done about eight cuts. The UK has done multiple. And this is a way to bring more money into the markets. And overall, student loans, credit cards, everything becomes cheaper. And we did have a complete explainer of exactly what you're looking for, but definitely jump in and sit with us. Now, overall, bullish, smaller cuts, right? This is what you want right here. So everybody understands that. 0.25%, likely to get 3 to 4 cuts going into 2026, right? So borrowing overall becomes cheaper. And of course, we dug up the information, and this is when we were arguing that 50 basis points will be bad for us in the short term, and 25 basis points will be better for us. And so far, the cuts do seem smaller, but the Fed is, Powell's not going to come out and say to you, "Oh, the economy is basically fucked, and I'm gonna cut 50, 75." This is not COVID type of environment. We do have COVID type of pressures on the labor market. So yeah, man, I hope that makes you more bullish. Graham said Black Mirror. Black Mirror is it's on my Netflix. Black hole up 12%. By the way, I know a lot of the people, the legends in my community, are holding it, but this one's on BNB. So metrics themselves are $8 million, 49 million FDV, 3.8 million volume, which is very good. Chart doesn't look bad. And right, is it the thing? Excuse my ears. The future of Black Mirror. So this is this is linked to the real show, right? Black Mirror experience. All right. Okay. So it is a real, trying to see what access dashboard, trying to see what the token is used for. My lady, what am I experiencing? She's in the Matrix. But listen, you know what? If this is the case, right? If this is the case, then good shout. It's worth watching. It is small enough, like I said, but just be careful with the tokenomics. I know they're doing a lot of, I think, airdrops and stuff. But yeah, that's a really good shout. It is really Black Mirror on the blockchain. Mamo, not Momo. Pratik, sorry, man. It's Mamo. Is it this one? It's got to be this one, surely. On base. $30 million, 1.9 million volume. probably on DEX, Coinbase listed. Pratik is a bad man. I like that. I like that in the sense that I could see it's a bot as well. What is it about? Let's have a look. Straight away on Coinbase. I mean, the website looks friggin' sick. It's a DeFi play. Smart money with easy nerves. I think we might have seen this one before. Powered by Moonwell, Base. Yeah, I think we've seen this on a previous live. Let's give them a follow. I think it's a DeFi AI agent, if I'm correct. It looks good, man. Looks very good. It's up 5x from the lows. A's good chart. Tokenomics still under 50% circulating, which a lot of the base tokens are. Human first routines, and of course it works quietly in the background, finding smart opportunities for your money while you focus on what matters, and that's your life. Think of Mamo, knowledgeable friend, AI agent. DeFi AI is the niche for this. Very good shout. Still relatively small, but I think last time we looked at it, it was smaller as well. But yeah, good shout. Pratik there coming with the fire, man. The base token launch, man. The base token launch could be one of the biggest teasers for this cycle. It has definitely given them attention. There's a lot to work out. Do they go through the Arbitrum route, announce an airdrop? Actually, Arbitrum denied it back in 2021 and said there's no airdrop. It's all fake news. And then they did one of the largest airdrops in crypto history. But the base token doesn't have a date yet. And I don't think it would be 2025. The right thing to do would be, rather than airdrop farming, if you're holding, say, some base tokens, I think they should just airdrop it. That would be the best thing, the best way to approach that. Wagwan with the markets. Markets are not really doing that badly. Bitcoin's down a little bit, but altcoins are holding way better. Man, we are flying. So it's just below the VWAP for Bitcoin. You can see here, resistance, resistance, resistance. 3 candles in a row. The last 3 hourly candles. Let's look at the lower time frames. Yes, we are attempting here to rather get above this blue line. For the half an hour chart, you can see here, sitting at an important level. And let's go change. What am I using? Yeah, let's use Heiken Aisha candles. So that's the picture for Bitcoin right now. We just need to be above. You see what's happened here? Got to be above. This level has just been so difficult. But I can see liquidity above, 117 has been taken. So CME gap sitting right there. So the next CME gap, unfortunately, is somewhere else. Further down. So what's ETH saying? ETH is at 2.5. Not doing bad at all. It's funny. Altcoins are actually moving slightly better than Bitcoin right now. Haven't seen you call that you sold and can't see it in your portfolio. No, I hold it in the ALF wallet, so it's not really tracked in my portfolio, but I do hold it, Vance, and I've had more here. I've made more ALF content than anybody else. I just I was just answering the question that was being asked regarding what's happening right now. Because what do? We give Alf the platform. We give Alf everything. We need Alf to come back and smash it. Unfortunately, I can't really do that for them. I only got 300 to spend. Should I start building my bag of Tau or say, okay, hell no. Investor Squad, $300 to spend. Do not touch those large caps. You have to take an opportunity and a chance, and you probably have to get a very good meme coin, very good gaming project, something that is sub 10 million, ideally sub $5 million or thereabouts. You're going to have to go risky with $300. Unfortunately, if it's $3,000, $10,000, yeah, then you go for the larger cap. But you don't want to 5-10x, which is not bad at all, which is a way you can actually build more money. But I would probably say look at the other narratives, maybe a low cap, some of the low cap niches. Let me see if I can open this. So this is, of course, it's not updated in terms of the project market caps, but there's good projects. There's small layer ones. You've got Peak, Alf, Peak twice. High Network is another layer one that hasn't moved. You've got Cookie DAO here. You've got AI Tech, SocialFi with noise. You could maybe you could risk it all and go for Moon Tropico, which is sitting below $1. You could maybe even buy Heroes of MAVIA. You could buy Lofi, Kokoro. You could buy Lemmy. You could buy Sea Dog. You could buy, Toshi's big now. You could even buy Foxy. So there are tons and tons of low caps you could actually buy. It just really depends on what you really want. B2 is gaining traction also on DeFi Llama, backed by big VCs. Yes, you are 100% correct. B2, I'm talking about the one on base, right? So despite the fact that it has a high FDV, maybe I'm thinking of B3, sorry. B2 on base, is it? B2. I think I'm thinking about a completely different B2. But B squared is probably the one you mean, right? So, no, the one on base. Is it the one on base? B2, getting traction. Let's have a look at this one anyway. I haven't got a clue of this one. I'm mixing it up with the one on base. Big VCs, let's go. Don't think this is it. DeFi Llama. Probably look into it a bit more. ASR, Seamless Protocol. DEX, what's going on, fam? Multi-chain coin. Graham, thank you for that. Founder of Moonwell, DeFi, and of course, Base Protocol, Optimism. That's pretty sick. Peace and love to you too, brother. Deployed capital now. Wait for the sell-off. Yeah, just chill on it. And BKNR. Guys, honestly, it's been an amazing stream, man. I'm literally in 2 hours and 20 minutes. So I'm going to take a chill. I'm going to go and catch up on my Champions League highlights. But I promise we'll do another one. B2's the ticker. I'll check all of that. We've done 2 hours. Let me go and watch my Champions League, guys. God bless you all. And let me know, smash a like if you want me to do another live stream tomorrow. I think we gained a lot tonight. And peace and love to you too, brother Cave. Hey, we need to talk about those gems. And maybe drop a meme coin as well, brother. God bless you, man. Take care. Good night.